The NASDAQ is open, and Plug Power Inc. stock, ticker symbol PLUG, is currently trading at $2.53 USD, showing a modest plus 0.40% gain intraday. This price action, while small, is immediately insightful because it comes on the heels of a sharp, near 9% drop yesterday. Most investors watching this stock, especially those newer to speculative names or those managing their own assets through platforms like a Fidelity brokerage account or engaging in self-investing via Robinhood app, are likely focused squarely on next week's earnings report. The expectation is simple. Another massive loss, albeit perhaps a smaller one than last year, and revenue that's essentially flat. That's the common narrative, a perpetual promise of future hydrogen adoption clashing with current, ugly financial statements. But here's the unexpected angle. The volume is what matters right now, and the institutional positioning suggests a much deeper game is afoot than just retail anxiety over a quarterly loss. The high trading volume over the past month, coupled with the recent aggressive sell-off, points to a sophisticated rebalancing, potentially driven by funds that use quantitative models to manage their positions around major volatility events, like earnings, rather than a fundamental shift in the long-term outlook for green hydrogen. When you look closely at the large institutional holders, you see minimal large-scale selling of entire positions, which is what you'd expect if the fundamental thesis was truly broken. Instead, you see a churning, a high-frequency trading activity that capitalizes on the fear-driven swings, which is why a small green bounce today, on slightly calmer volume, is significant. It might be the first sign of a temporary floor being established before the big news hits. The typical perspective on Plug Power stock is that it's the poster child of the green speculation trade, a company with an exciting vision for the hydrogen economy, but with a balance sheet that looks like it's perpetually under a lead-acid battery's worth of weight. Investors bought into the idea of an era where hydrogen replaces traditional power sources in forklifts, data centers, and eventually transportation. This high expectation was fueled by massive government subsidies and the general political will to move toward net zero emissions. However, the reality has been an incredibly difficult scaling process. The move from an expectation of easy, subsidized growth to the operational reality of building a complex, expensive hydrogen network is where the rubber meets the road. The company's colossal negative gross margins and consistent net losses, which are anticipated to continue with a loss of around 0.13 cents per share for the upcoming Q3 report, are the cold water on that initial optimistic narrative. The challenge isn't demand, it's execution and the high cost of producing, liquefying, and distributing green hydrogen. This gap between the ambitious vision and the current cost structure is the central tension that keeps the stock volatile and attractive to both high-risk speculative traders and long-term, patient capital willing to stomach the volatility. Let's dissect the recent stock movement. The stock had an impressive nearly 180% run-up at one point in the previous month, which was a clear example of money flowing back into beaten-down, high-growth speculative names. This surge was partially attributable to the successful commissioning of their Georgia green hydrogen plant, a critical step toward controlling their fuel costs and securing some large-scale electrolyzer deals, notably the one with Allied Biofuels for a massive 2 gigawatts of their Geneco PM electrolyzer systems for a sustainable aviation fuel project in Uzbekistan. That kind of deal provides tangible evidence that their technology is being adopted at a scale that transcends the forklift business they built their name on. However, those kinds of announcements, while validating the business model, don't fix the cash flow problem today. When the recent sell-off hit, it wasn't due to a sudden cancellation of a contract, it was a profit-taking and sentiment reversal that got amplified because of the high short interest, sitting at over 30% of the float. This high short interest means that every downward tick is intensified as short sellers press their bets, creating those dramatic intraday swings that are so common with PLUG stock. For those using an intelligent portfolio or a Schwab Intelligent Portfolios approach, this volatility would likely cause their automated rebalancing to trim the position, further adding to the selling pressure. The core problem, the negative gross margin, is why institutions get nervous. They are betting on the long-term adoption of hydrogen, but every quarter where the company loses substantial money on its core product creates a crisis of confidence. The underlying business of Plug Power is a fascinating example of vertical integration in a nascent investment space. They aren't just selling a fuel cell product, they are building an entire end-to-end hydrogen ecosystem. This ecosystem involves 5 key parts: electrolyzers to produce green hydrogen from water and renewable electricity, the hydrogen fuel itself, which they produce and distribute, the fuel cell systems, GenDrive for material handling like forklifts that run on the hydrogen, stationary power units for things like data centers and grid support, and the liquefaction and cryogenics infrastructure needed to transport and store the supercooled fuel. Their early success came from convincing large logistics operations like Walmart and Amazon to switch their material handling fleets from lead-acid batteries to hydrogen fuel cells, which offered faster refueling and consistent power in their warehouses. This material handling segment, while mature, is now a mixed bag because the cost of procuring hydrogen on the open market has been volatile and high, resulting in those crushing negative fuel margins we've been discussing. The true growth lever, and the part that excites investors the most, is the sale of their electrolyzer systems. Selling a 2-gigawatt system to a partner is a capital equipment sale with much better upfront margins, and it also establishes a long-term anchor client for their hydrogen production, which is a brilliant two-pronged strategy. This is where the forward narrative, the future expected reality, lies. Their pipeline of electrolyzer and stationary power deals is substantial, but it requires massive upfront capital expenditure, which is why the company is constantly raising capital, causing dilution and downward pressure on the stock price. This is a common hurdle for all true infrastructure plays in online investing. Now, let's talk about the institutional footprint. Firms like Vanguard and BlackRock are significant long-only holders, which tells you that major, passive funds tracking indexes and broad ESG mandates have to own the stock. They are the bedrock of the institutional float. However, the more active funds are what drive the daily swings. The recent insider activity showing some non-open market acquisitions by executives is a small but positive signal. While these often involve stock awards, the fact that some insiders are taking a portion of their salary and bonus in shares, even in the face of the recent volatility, suggests an internal belief in the long-term value, which is something a retail investor using an online investment platform should pay attention to. The short interest, though, is the immediate pressure cooker. A high short interest creates the potential for a massive short squeeze, where good news forces short sellers to cover their positions rapidly, driving the price up violently. Given the consensus low expectations for the upcoming earnings report on November 10th, any positive surprise, even a narrower-than-expected loss, or significantly improved gross margins from the Georgia plant could trigger that kind of violent upward move. The tension, then, is between the fundamental investors, who see the inevitable cash burn, and the momentum traders who are betting on a positive catalyst or a short-covering rally. When we consider the broader sector momentum, Plug Power is positioned in the industrial applications side of the hydrogen market, contrasting with companies focused solely on residential fuel cells or automotive applications. The key sector tailwinds are largely legislative and geopolitical. The U.S. Inflation Reduction Act and its clean hydrogen production tax credit are game-changing for Plug Power. The $3 per kilogram production tax credit dramatically lowers the effective cost of green hydrogen, closing the gap between their fuel cost and that of competitors, and making their end-to-end ecosystem immediately more compelling to large industrial customers. The long-term adoption of hydrogen in heavy-duty transport, a market that the likes of Tesla stock are trying to revolutionize with electric trucks, but where hydrogen offers a compelling alternative for long-haul and rapid refueling, is a huge potential driver. This potential is a multi-billion-dollar opportunity, but it remains a future catalyst, not a current reality. Macroeconomic pressures, particularly high interest rates, have been a massive headwind. Companies like Plug, which are capital-intensive and not yet profitable, rely heavily on accessing cheap money to fund their infrastructure build-out. Higher borrowing costs make that growth more expensive and prolong the time until they can achieve sustained profitability, which is a major factor in the stock's weakness over the past year. This macroeconomic backdrop forces retail investors, whether they trade through an individual brokerage like Interactive Brokers or use the Fidelity mobile app, to assess risk much more critically than they did during the period of zero interest rates. Looking ahead, the next few quarters will be defined by three critical items. First, the Q3 earnings on November 10th. The market will listen less to the revenue number and more to the gross margin and the commentary on the performance of the Georgia plant. If management can credibly show that the new green hydrogen production is materially improving their fuel business margins, that's a win. Second, the progress on the promised Department of Energy loan guarantee. They've been working on a